EduTrainer Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your EduTrainer National Insurance columnist, Steve Savant.
Well, welcome everyone to our EduTrainer Workshops. I'm Steve Savant, your EduTrainer and your coach. And we're talking about life insurance, the entry-level series. We're in series this week, 11 through 16. This is the 16th episode. And today we're talking about first and second to die concerns. What happens when I have partnerships that are together or family members together, husband and wife? I need to know first to die scenarios and second to die scenarios. Our episode today is brought to you by our sponsor, Lincoln Benefit Life, an Allstate company, and we're using Lincoln Benefit Life software. In the next week or so, we're going to be on this software, and we want you to go out to their site, www.lblsales.com/ETW. I want you to go out there and you'll see this page will come up. I want you to hit Run Installer and then download their software. We voted their software as the most easiest user-friendly software that's in the industry. It'll really help your learning curve to get familiar with their software, but more than that, you'll be able to go page by page. When I'm going through the illustration, you'll have it already set up on your computer and you can go page for page with me. It's a great learning curve. It'll really help your ability to grasp a lot of the concepts we're talking about. And remember, we're also giving away, and it's a big thing, but we think it's a lot. It's really necessary, the Life Insurance Manual with vocabulary. It's huge. If you say, Steve, I want that, just go ahead and order The Biz at brokersalliance.com. That's The Biz, THEBIZ, at brokersalliance.com, and we'll send it. And everything you ever see that we have here on the Mondo pad, always think, hey, is that in part of the giveaways? That's true. It's always in there. So with that instead, let's talk about basic first to die scenarios. Now, here's an interesting thought. Somebody in a marriage generally is going to die first. Sometimes it's true that there's a car crash, people are basically, they both die at the same time, but somebody, the coroner, somebody at the scene, somebody's going to make the call who died first. And whoever that person they elect that died first, legally, that becomes the first to die. And remember, that could have a lot of ramifications and consequences in estate planning. So it's important to be heads up on this. So you may want to start thinking about your documents, whether it's wills or trusts, or any of those instruments that really dictate power of attorney, all those things, and make sure you have contingents online with your main primary beneficiaries. You'll always want to know, hey, in case of a first to die, who do we elect? You could even say, if it can't be determined, here's who we elect as the first death. So first to die scenarios, because somebody's going to survive it, more than likely, somebody's going to go first. I've noticed in a lot of estate plannings that we used to do throughout the 1990s that we did an excellent plan at defeating estate taxes. What we didn't do is, when Dad died, which was 85 to 90% of the time, we didn't leave enough money for Mom to live on because we didn't expect her to live so long. Many females in the 90s blew by the actuarial tables. And so we were really great about estate planning, but we didn't leave enough liquidity for survivors. So when you think about first death scenarios, unless I see the mortality tables differently, I'm going to be sitting there saying, well, the odds are in a family situation that the male is more than likely going to die first. And of course, it's only exacerbated if the spread between the husband and wife is 3 years, 5 years, 7 years, or whatever. So when I look at those spread numbers, I'm going to be sitting there saying, I have to accommodate a first death scenario, more than likely the male, and then I'm going to go work backwards on that. If I'm in a partnership, I'm going to look at who's the most healthiest person, who's the youngest person, who's a person that's the older person, maybe he's not as healthy. I want to look at every first to die scenario so I know what to do for the survivors, the beneficiaries. So when I'm thinking about first to die, now there are not that many first to die policies that are available if you wanted to buy a policy that actually fit this. Most people are using small term riders on permanent contracts to achieve this. But there's still a few left out there that you could buy that actually pay on the first death with 2 lives on the contract. but most of the time we've been able to actually do a better job on single contracts. But they're out there. And what I'm always looking for in a first to die scenario is who will have to bear the economic burden? Who will suffer economic loss? That's the person I'm looking at, survivor. The first to die, that person will be gone, but who's going to remain? Now, on the second way of looking at this, we're looking at survivorship. Now, we really didn't invent this until we changed the marital deduction law. We didn't really have second to die or survivorship. And what happened was when Congress changed the marital deduction law back in the day, about 30 years ago, when they changed it, they let everything pass from dad to mom, because that was usually the scenario, or mom to dad, depends upon who dies first. And that would pass without any estate taxes. And so they did that in such a way where at least she would receive, the survivorship would receive it. But once both mom and dad died, then this is when the estate tax came on for beneficiaries. Well, second to die was invented so you could have two lives on one platform. Those two lives put together are actually cheaper than one life because the carrier doesn't pay till the second death. And we've had various variations of second to die, where we started out with whole life participating second to die, then we went to current assumption universal life. Now we have variable second to die, index second to die. We even have guaranteed UL second to die. So we have all these platforms on second to die based on pricing, sometimes based on the risk, i.e. variable. So when I'm looking at this now, I want to know, what's the actual tax? What's the actual exposure? What's the actual economic loss on the second death? What's the leverage of using second to die or survivorship policy? Is there leverage to it? And that's when I look at issues like this. The survivorship solution is huge. The problem is, over our lifetime, we've built up an estate. And depending upon where the government goes on the unified credit, we don't know exactly what it is now. It's pretty benevolent right now, $5 million each, or married couples, $10 million. But we're recording in 2012, and it's sure to change somewhere in 2013. We don't know what that change will be like, but most people think it's going to be less. And if that means that the unified credit's going to go down, that means the exposure with estate taxes is going to be greater. And remember, at the second death, we not only may have estate taxes, but we're still going to have to pay ordinary income tax that year, final expenses, transfer of property to children and grandchildren, charity of their choice. All those things still have to happen. We have to settle debts of the estate. All those things are important. So when I'm looking at survivorship life, I'm looking at these scenarios. One big one is who's going to be the owner? I suppose if I was low enough in my estate side and I didn't really have to worry about that, the unified credit protected both my wealth and my wife's wealth, I may still be able to hold that inside my own estate because the death benefit wouldn't exceed the unified credit. But again, heads up, that unified credit may be going down next year. Who knows if it'll be big. If I felt like no, I would only be bringing new taxes by buying a life insurance contract and owning it inside the estate, I might want to own it outside using an irrevocable life insurance trust, where I, as the grantor and my wife, we could grant money to that, and that trust would then buy second to die insurance to pay all the things I want to happen. And again, I might want to be able to take care of all my estate taxes, my ordinary income taxes, my final expenses that year, and gift to the charity of my choice. And I might want to create a legacy for my children, and even more so for my grandchildren. Ownership arrangements are really key, and even in business, sometimes you can use second to die depending upon age, depending upon your exit strategy and your succession planning. You could maybe use second to die. And now I want to go basic whiteboard and show you a few things on this. Let's assume that both our clients are 65 and that they're both non-smokers, but let's just say they're standard. If I was to buy insurance on $1 million, this may cost me $14,000 on the male. It might cost me $12,000 on the female, but if I use second to die, I'm actually creating two people on one policy, and that premium could be as low as $10,000, let's say $500. So there's leverage in second to die. If the clients were really healthy, and I'm talking about that they really had good health, what could happen is that they were both preferred and they were both 65 years of age. I might be able to get a 4-to-1 ratio only on the male's life. But on the female life, I might get a 5-to-1 for every dollar of premium. Or in a 6, where I'm using 65 and they're both non-smoke, but they're preferred health, then I might be able to get a 6-to-1. So there's issues here, and that issue is called leverage. Leverage on second to die is huge. The greater the spread in ages, the numbers just become astronomical. So I like to use leverage because now I'm using discounted dollars. Discounted dollars, this kind of bang for the buck. So if I used this idea, basic idea, I could say, if I'm going to put $100,000 in a single deposit, and I was to put this on the male, to putting in real numbers, again, I might be able to get $400,000 of death benefit. On my female counterpart, I might get $500,000. But on second to die, I'm sitting there at $600,000. You can see the leverage of my $100,000 single deposit against $400,000, $500,000, and $600,000. That is leverage. That's using discounted dollars. That's the power of insurance. And remember, depending upon how it's owned, there could be huge tax advantages on top of it. Those tax advantages may mean that this money, $600,000, goes tax-free. We already know that it has the tax favoredness of tax deferral. So we know we have tax deferral, it's tax favored, but if it's done right, whether it's owned by an irrevocable life insurance trust, or it's owned, depending upon how I own it, maybe my children own it, depending upon how I want to set it up, $600,000, I can get the leverage of life insurance, and then I'm going to get tax advantages or tax favoredness of life insurance. So once I've determined my survivorship needs, I want to be able to look at this and say, okay, what is the bang for the buck? What can I do here? And think about this. This is kind of interesting. What happens if dad is age 65, he's a non-smoker, but he's uninsurable, and mom is 65, and she's non-smoker and a table 4. This could still be better than the combined together, even though he's uninsurable. And she is table 4, which is 4 tables below standard in America. Those two, putting them on a second to die platform, may actually, well, it actually will, it'll be cheaper to use second to die. So even though the ages were the same, he's completely declinable, but the female equation, she's table 4, 4 tables below standard, it's still going to be better for my price tag, and I may only get $400,000 or maybe even less than that, $300,000 in death benefit in my $100,000 scenario. But once again, even with this kind of health condition, second to die is that powerful that it can sometimes overcome uninsurables and having somebody else on that same contract at table 4. As you get younger down the line and second to die, that you can have greater spreads in health difficulties or conditions. As we get older, when I get 70, 75, then this gap closes and you can't get that kind of leverage. There are certain demarcation lines where we say, it's just not worth to do it. But we'll tell you when that happens, because we're going to have to do 3 things: plot the line for male and female each, and then we're going to have, the third one is calculate the second to die. That's survivorship benefits. We're talking today about first and second to die, so we can calibrate life insurance for survivors.
This has been an EduTrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance. and sponsored by Lincoln Benefit Life, an Allstate company.